bring in John Ryding of RDQ Economics. He and I could talk literally for an hour without interruption about this amazing week. What is the single thing you and Conrad DeCardros are writing about this weekend?
Well, today it's going to be about the potential for Operation Twist and what that might mean. And I actually think it means very little, because it's just the same as the government changing the mix of debt issuance, and there's very little relationship historically between the average maturity of the debt and the slope of the yield curve.
I don't mean to put you on the spot. How much will the 30-year fixed rate mortgage come in if we twist and shout?
I don't think it'll do very much. By the way, I like the Beatles reference. We have that Beatles reference in the piece.
You quoted the economist Chubby Checker, I think. Something like that. But how much does that 30-year mortgage come in?
I don't think it comes in very much at all, because there's not much of a relationship between the slope of the yield curve and the average maturity of the debt. In Operation Twist, you've got a $7.7 trillion publicly held debt market. And if the Fed buys $100 billion of debt, that shortens the maturity of the debt by about 1.5 months. It's really not going to have the kind of macro impact. It's doing something as I think much more consequential. The other thing we'll be talking about will be the intervention yesterday with the lending out of dollars.
Let's dread it first chart. This is a chart we show all the time, but this is different. This is a zoom in from the end of 2009, and this is that Fed balance sheet with that balloon out to $3 trillion, $2.9 trillion you can see. And the fact is, it hasn't come in at all. I mean, we are elevated here at $3 trillion. Why can't we go to $4 trillion?
Well, I mean, the Fed can go to whatever it likes. It's got the power of the printing press. I'm not sure it's a good idea. My real concern with QE2, the quantitative easing expansion of the balance sheet, was that it inflated commodity prices. And that commodity price inflation has driven up actual inflation. So CPI yesterday came in 3.8% year over year, probably hits 4% next month. Core inflation is up around 2%. Could end the year close to 2.5%. And so if the Fed does more on inflating the economy, that hurts the very people they're trying to help, because it squeezes real incomes.
Bring up the chart here. This is a new long-term view we're gonna bring in here. I'm putting my hands up here, giving signals to our great crew. The continued great moderation. Look at this chart. This is a regression back to 1985, and then we zoomed in on the 10-year yield. The continued great moderation. I mean, yields are low for whatever reason, but the fact is we're less than one standard deviation off that trend from Volcker, aren't we?
And that, though, is very unhealthy, because real yields have fallen to zero. A healthy economy would have the government competing for private capital, and interest rates, bond yields, would be higher. So we have forced bond yields down, and I think we're running out of the ability to force down, and it's an unhealthy sign. Think of how low 10-year yields were in Japan, have been in Japan for the last decade and a half, been around 1.5%, and that economy has struggled to grow. So low yields are fundamentally a bad thing. It's a bad sign. It's a sign people don't want to take risks.
Right. Folks, every guest, particularly those of national and world authority like John Ryding, have phrases that they own. Ryding owns the putting green. It's that simple. When you talk about the putting green in economics, people think about John Ryding. That was quite a putting green yesterday, wasn't it, by these central banks?
Well, it was a good move. It wasn't monetary policy, it wasn't easing, it was lender of last resort. And so we had a fundamental problem. That there was lack of willingness of the U.S. investors to fund European banks in dollars. And the ECB can't print dollars. So they borrow them from the Fed through the swap lines, and they're going to lend them out over the turn of the year. So it's just saying, we are here as a lender of last resort. We're not going to have a liquidity crisis for European banks.
I like how you go, as you do with your service at the Bank of England and with the Federal Reserve System. You go down to the actual nitty-gritty, like the new president of the Kansas City Fed, who wouldn't know ISLMF if it hit her over the head. What I like here is this idea it's about currencies. Why should the Chinese worry about euros?
Well, I suppose that when you're sat there with $3 trillion and change of foreign exchange reserves, you own a third of the world's reserves. You don't want to have it all in one currency.
Dollars, yeah.
There has to be diversification. So the only other viable currency, and if the euro collapses, it's clearly not a viable currency, is the euro for diversifying those reserves into. So sadly, the euro was not created with the kind of structure on the fiscal side it needed to have to make it work. It got away with it for 10 years. Now we really do need to see some fundamental treaty reforms, I think.
This is great. John Ryding with us, RDQ Economics.